Hello, Sahil. Nice to meet you, and very, very welcome to this episode of Builder. How are you?
Doing good. How about yourself, Michaela?
All good, all good. It's a pleasure to have you here, and I would like to start directly with a short introduction of yourself and, of course, of Affiniti. I know you
Yeah,
guys have been very, very busy recently, so
yeah,
I'm looking forward to hear what you're doing.
yeah. My name is Sahil. I'm one of the co-founders and president of Affiniti. What is Affiniti? Well, we are here to serve the backbone industries of America with powerful financial technology. If you're in the fintech world, a great analogy is we're bringing ramp and bricks to old America. And so what we do is we offer a one-stop shop, what I like to say a financial operating system, spend management, expense management. We offer loans, accounts payable financing, accounts receivable financing, lines of credit, term loans. And we're expanding the universe of financial products that a small business can access all in one singular platform. And we're introducing this to a sector that has actually never worked with fintech platforms. They've been traditionally with community banks, credit unions, and really old finance is what we like to term it. And so we're bringing this novelty, this innovation, and it's spreading like wildfire. The three states we do the most business in are Nebraska, Arkansas, Tennessee. It's not California, it's not Florida, it's not New York. We're not here to serve the coastal cities like all the other startups do. We're here to focus on real problems for the real world. And so that's a little bit about Affinity.
Nice, very, very interesting. So you're basically serving the backbone of the industrial sector in the U.S. And am I wrong? You are directly targeting final customers, or you're a B2C basically?
So we work with small businesses. So
Okay.
we are a B2B solution in that regard, where these are generally 10 to 20 employee small businesses. They're running your local pharmacy. They're running a doctor's clinic. If you've ever gotten your teeth done, most dentists in America are independents. So that's a small business, right? So those are the small businesses that Affinity works with and offers our full suite management solution.
Okay, nice. So I would like to start talking about first of all the overall market that you're starting to address. So every founder's dream is to catch the U.S. market sooner or later. You started there, and you're having a lot of traction. So first question from my side would be, how is the fintech market nowadays in the U.S. and which are the
Yeah.
main challenges that you're facing there?
Yeah, I think the fintech market in the US is extremely bloated. And I'll say about that is, or I'll expand into that. I think there's too many fintechs, and I kind of alluded to this previously, focusing on the same population of businesses. So like Ramp and Brex are a great, I guess you could say, example. Ramp,
Yeah.
Brex, Mercury, Row, all of these startups, right? What do? They serve VC backed companies, they serve private equity, they serve enterprise. Rippling does the same thing, right? Like I can name maybe 10 financial solutions, all focusing on the 10% of this economy and not the 90%, which is small businesses. And so there truly is not much novelty being brought. Everyone in Silicon Valley has access to a cash flow card, which was pioneered by Brex. And now every company that wants to serve a VC backed startup, they use the same underwriting formula. So I say all of this because I think like there's a lot of innovation to be brought, but it's not being brought to the right people. I think, and that's kind of to touch on your second point of what are the issues in the US is it's a game of CAC. You know this very well because you've been in
Yeah.
fintech for a long time. CAC is everything in fintech. Like, how much are you actually acquiring a customer for? If you're not acquiring customer cheaper than a traditional financial institution, you have no competitive advantage because a traditional financial institution is going to beat you on cost of funds. They're going to beat you on servicing. They're going to beat you on scale. And so you need to find ways to acquire customers and get your payback period short enough to where you're actually able to beat a traditional financial institution from a profit perspective. And that's why, you'll see like a lot of fintechs, when they enter public markets, they get chastised because they never truly figured out the CAC problem. They just got a bunch of VC dollars injected into them. And then what they found out was, holy crap, customers actually don't pay us back in a year. It takes 5 years. And
Yeah.
so you lose your competitive advantage. But all that to say, right? We need to start bringing fintech into an audience that has never interfaced with this
Yeah.
technology, and that's what Affinity is doing, right? Is we're not here to serve VC companies.
I think it's a very interesting point. Let's say a couple of years ago, it was 2020, 2021, I was frequently talking with the couple of neobanks and digital banks in Europe, and they were already having some, let's say, very, very high customer acquisition costs, like, from 70 to 80 up to 150 euros per user acquired. And that is a huge amount of money that is going to take a long time to recover. So what you're saying it makes a lot of sense, to be honest. So the very, very simple follow-up question is, okay, how are you guys actually taking this down? What is your go-to-market strategy here, and how are you lowering down that cost of acquisition in order to have that advantage?
Yeah, so part of the innovation at Affinity is our go-to-market strategy. So
Mm.
the audience that we're acquiring is unbelievably difficult to access because they're offline. 60-year-old farmers in Nebraska are not on Twitter or X now. They're not on LinkedIn. So how the heck do we get in front of them? We go through their trusted trade association. There's three
Mm.
to four things that a small business cares about when they're running their company. One of them is obviously their community. They care about serving their community. But another thing is their trade association. And if you're not familiar with the trade association, think of it as a union. That'd be the best adjacent example. It's a group of professionals that unionize and they fight for their profession on Capitol Hill. They get purchasing power when they group their purchasing power as one body versus separately negotiating against every single supplier and vendor if you're a farmer. And so there are 14,000 of these trades across America. And what we do is we partner with the National Community Pharmacists Association, which is every single independent pharmacy in America part of this association. If there's one way you can acquire the customers we're acquiring, it's through their trades because they read every single newsletter. They read every single magazine from this trade association. They go to every single conference. Frankly, like you look up some of our customers and they're in towns with like 400 people and you're just scratching your head like wow, like this is truly backbone America. And so
Yeah.
that's our novelty is we have found this go to market strategy to unlock and access a population that has never. If you said Brex, if you said Ramp, if you said Dave, Affirm, Klarna, they would be like, what is a firm? I've never heard of a firm.
Mhm.
And that's the beauty of our. And so a couple statistics here. We have a 6 month payback on CAC at Affinity.
Mm.
So in 6 months, our customers we're breaking even and profitable on them, and
Wow.
we're acquiring each business for less than $100.
Wow, that's a
And
very
here's the
good CAC.
exactly, and here's the best part. Each business on average is spending $17,000 a month on our platform. These are SMBs. So we are
Wow.
setting a new standard. We are winning top of wallet. We're getting paid back quickly. We are making profits on our businesses within the first calendar year of them on our platform. And all of this to say the reason why is because we don't need to compete against 100 other fintechs that are driving the price of acquisition costs. Because someone's giving tablets and another guy's giving MacBooks and another guy's flying everyone to Hawaii if you come to their happy hour, right? We don't need to compete against all of that.
Oh, that's very, very interesting, to be honest. I think that there are very couple interesting point, a couple of common points with other market too. So you were talking about union, and I think that that is not present only in the US but also in other market. For example, in
Yeah.
Europe, you can find very, very similar organizations in Italy, in Germany, in France too. So I would say that part of your go-to-market strategy is also very easy to internationalize, so you could
Yeah,
easily do the same in other countries that have more or less the same, let's say, setup as the US have right now under that point of view. And that is, to be honest, very, very interesting. um, let's get back maybe also to the latest news that you had. I know that you
yeah,
recently closed a 60 million round. So
yeah.
first of all, congratulations. Raising money
Thank
in
you.
this economy,
Yeah,
in this environment, is not easy at all. I
totally.
would love to ask you about that experience. So I know it wasn't easy, but I would love
Yeah,
you to tell me about how hard it was.
yeah, yeah. I think raising for fintech in high interest rate environments probably the hardest thing.
Yeah.
The multiples, because like, and for everyone watching this, like how investors view your business is they will always comp you against your biggest incumbents you're competing against, and how their revenue multiples are on public markets. So here's the issue: when interest rates are high, what do equity investors do? They're like, we're going to give these fintechs a 2x revenue multiple. So like you'll see a SoFi making $4 or $5 billion of revenue a year. They're profitable. But guess what? Public equity investors are giving them a 2x multiple. So their market cap's 8 billion. What's that do for all the other fintechs? We all get 2x multiples on our
Yeah.
revenue because they're like, hey, that's what you're going to get in public markets. And so
Yeah.
it's you have to get the right investors, right? Because like now
Mm.
you look at a firm and the firm's trading at 20x revenue multiples, like
Yeah.
close to, right? And a firm is just no different than stuff. They are a lending company at nature. Klarna, they're trading. Well, they haven't officially announced the IPO price, but like they're going to
Yeah.
trade at like a healthy revenue multiple. And so you need the right investors. Someone who's trying to apply a SaaS multiple and trying to commingle that into a fintech company, it's just not going to work. They're not going to be alignment. I think all payment companies eventually will be the best SaaS businesses because once you provide enough value to a customer, charging them a flat fee is the easiest part because you could justify
Yeah.
it. I actually think getting someone to deposit 100,000 of their own capital into your institution is tremendously harder than being like, hey, pay me $100 a year. That's why fintechs notoriously have lower churn rates than like a SaaS platform. And so, look, all of this to say, it was really hard because the interest rates were really high, and so investors, and we are like at heart, we do have a capital market side of this business where we have to raise debt because we are a credit card that's unsecured, and so we're extending capital. And so like investors don't love debt companies. But I think great businesses that show strong product market fit are undeniable. And we were just growing. Like we got to $1 million of revenue within 90 days of launching. And so
Wow.
yeah, so like that type of I guess pickup from a customer, I think investors really resonated with that. And I also think the customer base that we're working with is compelling because it's not these Y Combinator startups that investors are constantly underwriting because everyone wants to serve them. It's this pharmacy owner who's making $8 million in a town of 500 people, and they've just never seen an audience like this, and they're like, "Wow, this is like incredible." And I think it's like when you look at customer bases, I think that's another important part equity investors do underwrite is what is your quality of customer? Like, do you have a strong customer base that you can scale your business with, that is using you as top of wallet, that's willing to pay, that's engaged? Are they on your platform every day? That's what Facebook did really well is their initial customer base of college kids, they were logging in like every single hour. And
Yeah.
that's what compelled Peter Thiel, like, holy crap, like I need to put more money into this. People are logging in. So all that say, now that interest rates are coming down, there's a new president in office who's notorious for trying to lower interest
Lower
rates
it
close
down.
to
Yeah.
zero, right? And very friendly from a regulation perspective. I think 2025, we're going to see a craze of IPOs.
Mm.
And with those IPOs, we're going to see a lot of capital back into fintechs that have grinded it out built the foundations. And I think everyone is gonna get a lot healthier valuation and
Mm.
multiple in 2025. But 2022 to 2024 are very difficult to raise.
Yeah.
Yeah,
No, I can strongly feel you, to be honest. Like the last 2 years have been, very, very tough for every fintech startups. Raising funds were almost impossible for many founders out there.
yeah,
Interest rate were so high. There were no liquidity events whatsoever. So no IPO, no M&A, nothing basically on the market. And that means that there are a lot of dry powder that is
yeah,
not possible to deploy because basically it's blocked in assets. And that was a problem. I also agree with you. I think that in 2025 we will see some of that liquidity coming back to the market, and I think that it will be mostly driven by a couple of liquidity events.
yeah,
So you mentioned Klarna that is going to be public in 2025. I think that we will see probably another couple of good IPOs in the US, and that could potentially start the wheel again. But yeah, overall, I think that was two very incredible tough years that we saw. How long does it took for you to raise funds in terms of time?
yeah. Generally, it takes I'd say 2 to 3 months. Um,
Mm,
it's all dependent. It's funny, right? The more data you
mm,
have, the longer the deal takes. So
yeah,
like we raised our capital in tranches. It wasn't all 11 million equity at once. Like we raised like it in batches. And like the earliest batch was the easiest to raise because there were nothing to underwrite us on. It's just like, okay,
yeah,
here's two founders. Like, do I
yeah.
like their
Their
grit?
idea or
Do I
not?
like their idea, right? I have no data to underwrite, so let's get this done. Let's get this done. Like let's wire them next week and like, but
So there
like
was basically no due diligence at all.
the diligence was, do I think this person's capable? But like that's pre-seed capital, right? It's like
Mm,
there's
yeah,
not anything you can do to
yeah,
diligence, especially in fintech where most people need money to actually build the product because it's regulated half the
yeah.
time, so you need bank license and so on. The last tranche of capital that we raised was a strategic to keep growing our revenue and hold out so we can build a stronger and healthier valuation for our Series A. And so that was the hardest. Ironically, even though we were doing the best as a company, and the reason why is just because there's more to underwrite. They want customer calls. They want to talk to our association trade union partners. They want to look at our CAC to payback period, right? They want like
Mm,
there's like a million metrics. What's revenue per employee? Burn multiple. Like the more data you have as a business, the more speculation is going to be driven from an equity investor because
mm.
they have more to underwrite, and that's kind of why like it's a blessing and a curse to be doing well. It's also why like you'll see companies that disclose over disclose. Kind of what I've learned for anyone watching who's trying to raise funds. What I've learned is if you over disclose, you're uninteresting to an equity investor. But if you
Mm.
don't disclose a lot and you slowly, like you dangle the carrot, they're going to
Yeah.
start reaching and trying to grab the carrot. As don't overexpose information about your business unless the investor is serious about investing. Because what an investor's job is to get as much as data about every startup that's raised and brainwash you and get all your metrics and then compare you to your competitor and be like, okay, look, here's who I'm going to start like picking and choosing the winners in. So, yeah, I know I went off on tangent there, but
No, no,
through
but
some
it's
thoughts.
very interesting, to be honest. It's an interesting concept, and I think that you are also right because as an investor, there are very very few data out there on many of the startups that I've invested in the past and I currently looking at. It's very very hard to find those information. Most of the time, you have to trust the founder, or you have
Yeah,
to try to get the few amount of data that you can find out there, but it's not going to be the same as making a DCF model on a public company. You
exactly.
don't have a lot of data, you don't have financial statements. Most of the time, you need to talk and dig a lot in order to get those data. So I think that is also it has also something to do with the fact of getting involved with a company. If I start talking with a startup and I need 3, 4, 5 meetings in order to get those data, I start to get attached to that startup. I want to know more, and in the end, maybe I'll be more willing to invest on them. I think it's a very interesting concept, to be honest.
Yeah, yeah, exactly. I I think I always see this with founders is they
Mm,
get excited when an investor reaches out to them and they're like, "Oh my God, they're looking at a startup," but don't get excited. Like all of this to say, investors' jobs are to collect as much data on every startup in existence, and every investor is going to act interested in you, and then they're going to ask you for
mm,
this beautiful word called a data room. The moment you pass your data room, it's like you've opened up your legs. Like the
yeah.
moment you pass your data room. So, um, at Affinity, if you're not serious about investing, I just tell them like I'm not interested in talking to you. Like, I'm not going to show you my data. I'm going to give you some high level points. If this compels you, come meet us in person and I could walk through all our data together in person. And so,
Mm,
like, we're very selective with our equity investors. And that's just build look because we're doing good as a business, we can do that. Get the leverage. If you're a founder, get
mm.
your leverage. That's what matters. You don't want to be on your knees begging investors for capital. Build an awesome business and get the investor begging on their needs to put dollars into your business and buy your stock. That's the
Yeah.
dynamic you want to create.
Yeah, yeah. It's also not very easy to do, to say no to a possible investment or to
Yeah.
say no to investors. It's not easy at all because I would say 90% of the startups out there are, crawling for their life. So
Yeah.
they're trying to survive. So if the wrong investor come and it's offering money, they will. It's going to be hard for them to say no. So it's very, very hard. Maybe also because it is hard, maybe it's the right choice most of the time.
Yeah. Yeah. It's situational, right? If you have,
Yeah.
you're on the last dollar, you got to take the devil's hand.
Yeah, yeah, absolutely. But let's maybe talk a little bit about the operation, your day to day, a little bit more.
Yeah.
I've been talking with a lot of founders recently, and one of the most common topic with everyone was, let's say, on how to choose the right people to work with.
Yeah.
Hiring is one of the most critical part of founding of startups. Getting the right people on the right problems is another one. So I would like to understand what's your take on on the hiring part, and how did you
Yeah.
choose the people that you want to work with or that you want to be there to solve problem for you.
Yeah, how I look at hiring is that I actually don't care a ton about the credentials. I
Hmm.
actually care about the why. Because the why behind why you're joining a startup means a lot more than your
Hmm.
credentials. Like we every founder's made this mistake where they're like in awe because this guy who spent 20 years at this big company. He was a VP or
Hmm.
a managing director, and you're like, oh my goodness, like he wants to join my startup. Like I feel great. Let's come. I'll overpay you. I'll give you equity, and then you find out like the why was not the correct why for that guy who wanted to
Yeah.
join. He didn't want to put the 9 to 9. He wanted to put the 9 to 5. He had kids. He had commitments. And it's just a total mess. And so, like, how I
Hmm.
look at hiring is like, frankly, I ask them, you know, um, what their purpose in life is. And,
Hmm.
like I ask very deep questions like, why, why do you want to take a salary cut? And I actually try to convince the candidate not to join us. I'll tell them every problem in the business. And I'll say, man, like this is likely not, I say this quote for quote. I say, we're likely going to fail. Like everything's telling us we're going to fail. Why do you still want to stay in this conversation? We're likely going to fail in a year. You might be jobless, and if they can take all of this kind of skepticism and they're still excited about continuing the process, then I know I have someone where
Yeah.
if I had to cut salaries by 50% to keep the lights on, they're going to volunteer and they're going to say like, let's fucking do it. Like, I don't know if I can curse, but that's what
No
they'll
worries.
say, right? Is they would be the person to
Yeah.
lend the hand. So get the people with the right whys.
You want warriors on your side, basically. So you want people that are ready to fight to keep this alive.
Missionaries, not mercenaries.
Exactly, exactly. Well, it's a very good point, to be honest. I'm wondering what's the rate there. I mean, how many of those people actually say yes?
We spend 3 months hiring like
Yeah.
one or two rule. It's a long look. Like I mean, that's the trade off, right? Because we make it such an difficult. We're not selling the candidate. We're actually telling them not to join us. It just takes longer, but it's I've tried the opposite where we just try selling hard. And I ended up firing probably every single one of those candidates because they're just fundamental misalignments. You just need
Yeah.
to have pure alignment in everyone's why. Or else just when times are tough, like people are going to hang the coat up, and you need people who are going to grab their coat and be like, all right, let's go to war.
Yeah. Yeah, you know what? I saw that happening in many of the startups that I saw in fintech. Because you start acting in this environment, you start working, and you think, okay, maybe I found someone coming from, I don't know, J.P. Morgan or Goldman. They come from such huge and overqualified organization. They must be good for sure. Then they joined, and you understand that they are not aware of the startup environment. They don't know how to act. They are very very used to follow orders, and if something went wrong, they don't know what to do. So many of those people quit a startup environment after 2 months, 3 months, because basically it's not the environment for them. And it's not that the startup is wrong or the corporate side is wrong. Is the point here is that is not exact environment for them. They are looking for something else, and they're not ready to keep up with the fight. So they're not the good fit in that direction. And I saw that happening basically all the time, to be honest. Mostly in the early stage, when you have a little bit of funding and you
Yeah,
start saying, okay, I want to hire exceptional people. And exceptional people in the beginning means people that are coming from very very well known companies, and that is not the right the right choice.
exactly right. It's alignment, and that's what you're
Yeah.
alluding to. It's alignment. And that's not to say like I think there are people who have awesome resumes, but their alignment is there, and so they
Yeah,
come in
exactly.
there and they just 10x your business immediately. There are people like that, right?
Yeah, yeah.
It's just your job as a founder to understand their why, and then based on that why, do we see the world similarly, and do we see the why of why we're both building this company? Is that aligned? And if that's there, like bring them on.
Yeah, absolutely, yes. So, yeah, no, that is very interesting. But let's talk about a little bit more about the future. So we were talking about 2025, that is going to be, hopefully, I hope for everyone, a year of liquidity, let's say. So a year that
Yeah.
will, bring back a lot of the capital that we need in this environment. So I would like your take on the future of the market itself, and maybe also a little bit more on the future of Affinity. So where are you guys going, or where are you plan to go? If I extend the next time frame to, I don't know, the next 5 years, where are you want to be in 5 years from now with your company?
Yeah. I think if I don't go to um, if I don't go in public
Hmm.
and see a card that's powered by Affinity, then we did something wrong in 5 years. We didn't grow fast enough. We didn't grow large enough. Um, that's kind of my gauge of success is if
Hmm.
I'm going in public, if I make 1,000 appearances in public and not a single time I saw a card that was powered by Affinity, um, then we didn't touch enough small businesses and they're not using our card. And we didn't succeed in our mission because there are 33 million SMBs out there and they employ probably 50 to 60% of America. So the odds of us not having a card that I could see in public helping an SMB would be very,
Yeah.
like that's the
Very
goal.
low,
And
to be
and from a
honest.
exactly right. And from a financial perspective, like we want to take this to IPO. We want to be a multi-deca-billion-dollar company. Investors always ask me like, what do you want this business to be? And they say you must want it to be the next Brexit ramp, and I laugh. I say, "What? You think I want to be that? I want to be the next J.P. Morgan." Like that.
Hmm.
That's the standard we want to set. We don't want to be another fintech, small $10 billion. We want to be $100 billion market cap business. Sort of what, um, Nigel Morris and Richard Fairbanks did for Capital One. Like we want to rebuild
Hmm.
that success in Affinity, and so that's where we want Affinity to be.
Hmm.
Where do I see the markets? I actually think what investors are going to find is every business is going to become a payments business at heart. And that's what
Hmm.
investors are slowly finding, right? Those vertical software players, Service Titan, that's a great example. Service Titan's IPOing. at like 18 billion or 16 billion dollars. Pure SaaS, 90% margins. They serve heating, ventilation, air conditioning, cooling, and refrigeration companies. They're slowly getting into payments. Like they're slowly getting into like financing their SMBs that are using their software, right? A lot of vertical software plays are starting to integrate their own financing solution. DoorDash, for example, some a market like an order and delivery platform you'd never expect to get into finance. Guess what they do? They actually fund the restaurants now. They offer DoorDash
Mm.
financing, right? Every company will have a payments platform, or I think most businesses, especially serving businesses, will have some component of payments within it. And what that means is if you are building finance companies right now, especially credit companies, and you can nail down the credit and capital markets, your opportunities are endless because every business, the one thing they don't want to do is get into credit. And if you can master credit, I think we're done with the world of debit and we're with the world of
Mm.
credit. From the Durbin laws happened, all the neobanks took advantage of the debit card cash back. Like we get higher interchange. That was the
Yeah.
2010 to 2017 where Chime, SoFi, Moneyline, Dave, all of these businesses they capitalized on Durbin, but now we're going to see credit innovation, credit card innovation, capital markets innovation, debt innovation, and this decade's going to be glaring for anything credit, and so that's kind of my prediction.
That's a very interesting take. I would say that the one that you described is exactly the vision for embedded finance. We
Yeah,
have this vision in the market that every single company out there, every market, every vertical will have finance embedded in and integrated, so that you can make payment inside of an e-commerce, or you can ask for a loan inside your, I don't know, Spotify card or something like that. So I think that we saw a lot of business going in that direction, and I think that is probably, you're probably right under that point of view. So we would saw many more integration. In terms of debt and credit, that is a very interesting take. So I'm thinking that, there is a vision that is very divided between, for example, the US and Europe. So, for example, in the US, there is this concept of credit that is preponderant, mostly with retail customers. Instead, in Europe, we have the debt concept, the debt side of things. And I think that there are very different under that point of view. Um, and I'm not sure which one of the two will end up winning, to be honest, in the end. But your take is very interesting. But I would like to ask you one question that I saw very recently for a friend of mine.
yeah,
I don't know if you know, but recently there were Revolut that is thinking about getting a banking license in the US. We
yeah.
have
So
Neobank doing the same very recently. One of the questions that just popped in my mind: why do you think the US do not have like a digital banking champion, like a real, huge digital bank like Revolut or N26 or Newbank
uh,
or others? It's kind of strange for a market that mature and that rich to not have something like that.
it's a great question, and I think that the brute answer is consumer finance has been handled pretty well by incumbents. It's just the
Hmm.
truth. Like I actually look at um the champions for neobanks in
Hmm.
America, and that's Chime is what I would say is the
Yeah.
champion. But here's the thing: Chime is a champion for subprime. So
Hmm.
anyone who's a high income earner or anyone who earns a decent income is not using Chime. You know, they're using
Hmm.
American Express. They're using J.P. Morgan. They're using
Yeah.
Charles
Good point.
Schwab, right? And so the innovation for fintech in America has primarily been for subprime customers who didn't have access because traditional
Hmm.
banks don't make money on them, and so they were essentially pushed away. Like J.P. Morgan doesn't
Hmm.
want the guy who makes 30K a year, who spends $50 on a debit card a month. They don't make money on him. So they're like, we're gonna not we don't want you on our in our ecosystem. Whereas Chime is like, hey, we're going to capitalize on this like low hanging fruit where all these people are not being served and they're paying overdraft fees, and we're going to offer this like subprime solution. So I think what America's neobanks have done is they've championed. We have champions in the subprime space.
Mm,
All of these companies are champions in the subprime space. What Nubank and Revolut did was Latin American finance was just nobody wanted to hold in their local currency, and nobody
mm,
trusted the government and all the banks. Could there was a lot of crony capitalism that was happening, and so like wealthy people use Nubank. That's the misconception. Like, the highest income earners all over Latin America are using Nubank. And that's the key difference. Same thing in the UK. Lots of high income earners, Henrys, for example, which are like
mm,
high income earners that are young, are using Revolut. That pickup is not happening here. High income earners, young or old, are not using neobanks. They're using American Express. They're using JP Morgan. Um, and so that's the key difference here is both Revolut and both Nubank, they won over high income earners, not just
mm.
subprime. And high income earners, it's a power law game, right? Most of the high income earners make them most of their profits. Um, so that's kind of my intuition. I do think also Nubank is just the best financial
Mm,
institution. They just beat everyone, and the reason why is because there are no APR cap in Latin America.
mm.
So Nubank's profitability will never no other company will be able to beat them in profits because look, Nubank can charge customers 99% APR, and the
Yeah.
risk makes sense for a business like that.
Mm,
Regulation bars US based fintechs and even UK based fintechs and even Europe based fintechs. Regulation bars us. So like
mm.
stable coins will dominate in Latin America and Africa, but they will not dominate in Europe and America, right? Which is why like we see most of the push for cryptocurrencies coming from third world countries, El Salvador,
Mm.
and so on. So these are I know I threw a lot of takes out there, but that's kind
No,
of
no,
my
no, but
overall
it's kind of a
consensus.
good point. Most of what I agree with about the profitability point. So the profitability margin of Nubank is crazy.
Yeah.
It's out of this world. But if I have to be honest, I think that Revolut has a huge advantage in terms of product. So I've never saw a company being so fast to deploy new features in an environment tough like the financial one. So they have regular update, and when I say update, I don't mean we have updated this logo. No, I mean new feature coming out every single month, and this is actually crazy in this environment because it's not easy to produce a new feature that is compliant, that is under a banking license, that is regulated, and they are doing that constantly in different markets with different regulation at a velocity that I never saw before. So I think that they have that advantage. On the other side, I was speaking recently with a payment orchestration from Latin America, and they were telling me about the kind of difficulties that they have there from an open banking point of view, for example, and thinking that Nubank is able to do what they do in that kind of environment just tell you the fact that they're very very good under that point of view. So I think that we will see sooner or later a huge clash of king,
Yeah.
under that market because they are very very good and they're competing in the same markets worldwide. They have both come to Saudi Arabia recently, to
Yeah,
Mexico
I saw that.
recently. They're going in the US recently, the two of them. So we will see because it's going to be very, very, very interesting, to be honest.
Yeah, yeah. I think they're both as much as we say, they're competing against, one another in markets. The
Mm.
market's just so large, the TAM is so large.
Yeah,
There's going to be multiple winners, right? There's going to be a
yeah.
world where Revolut, Nubank, and 10 other neobanks. It's kind of like the next generation of GSIBs, like globally
Yeah.
systematic important banks, right? We had JP Morgan, Capital One, Citibank, Wells Fargo, or Bank of America, not Capital One, right? And
Mhm.
then there's going to be next generation, New Bank, Revolut, and then like two other
Yeah.
large neobanks. It's inevitable. I'm curious who the other two, three neobanks that are slowly emerging will come and compete. I think one is definitely going to be in Africa. And I don't know enough about the African markets, but there's a lot of low hanging fruit. there's a lot of underbanking, and the population is pretty massive. Nobody's doing it right in Africa. So I think the next Revolut new bank is going to come from Africa. That's kind of my take.
To be absolutely honest, I kind of had a couple of conversations recently that are pointing me also in the same exact direction. There are a couple
Yeah.
of very good founders launching neobank in Africa, in a couple of very interesting countries like Nigeria, South Africa, all the
Yeah.
sub-Saharan region is very, very interesting. There are very good founders doing that right now. And I strongly agree on this one that we will see a neobank, a very good neobank coming from that continent very, very soon.
Exactly.
And yeah, can wait to see that. Maybe last question on my side,
Yeah.
more on a personal level. Let's say, given the fact that you founded your company, you recently raised money. What's your advice to everyone else? You know, doing exactly the same out there at the moment. So, what's your advice to new founders in the fintech space that are going through what you have been going through in the last couple of years?
Yeah. Look, first off, like, I don't know if you know this, but like, I'm 21. So, um, like, for everyone listening, you probably are older than me, have more experience than me. And so, um, just like my best advice is just do it. Like the best way to learn something, just do it. Like I couldn't get a credit card 4 years ago, and now I'm building a credit card company, and I know every little intricate thing about a credit card, from the transaction flow of funds to the capital market side. I know securitization, like I know that all of that because like I just got my hands dirty. And so like when you're building these new fintech companies and you're building new products, and you aren't sure, if you are the right person to solve the problem, I think you just need to get your hands dirty and figure it
Mm.
out. Because like the experts in every industry are not the theoretical experts. Like it's not the guy who got his PhD in aerospace engineering. It's the guy who's actually building rockets who probably understands a lot more about aerodynamics and in all of rocket engineering. Theory is overrated. Doing is better. And so like just do what you say you're going to do to investors. Look, do what you tell the investors, right? If you tell investors I'm going to do XYZ and I'm going to hire a team out to help me, why should they invest in you? They should invest in the team you're going to hire, right?
Yeah.
So figure things out yourself. Be curious, be knowledgeable, be smart, and I have a saying here, which is what matters is your slope and not your y-intercept. So your
Mm.
ability to learn matters a lot more than where you're at in life. And that's why I always say pedigrees don't matter. How curious and how quick you are and witty you are matters a lot more. And so if your slope is high, then your trajectory, your y-intercept is infinitely higher. So focus on slope, not y-intercept. Keep learning and get your hands dirty. That's the best way to learn.
Yeah, strongly agree on this one. Sahil, it was a pleasure to have you here. It was a very, very interesting conversation, to be honest, and I'm looking
Yeah.
forward to see the next steps of Affiniti. And I
Yeah.
will keep a closer eye on you.
Thank you so much, Michele. Have a wonderful rest of your day, and best luck to all the viewers watching.
Yeah,
Chat soon.
thank you very much.
Cheers.
See you next one.
Bye bye.
Bye.